You might be sick of the term COVID by now, but the fact is, it's affected the supply and demand of many assets, including real estate. With the complete set of TREB data being released, I've taken the time to analyze the data and summarize the biggest changes to real estate in Toronto and the GTA in 2020. Now that the vaccine is being rolled out, it's possible that some of those changes might be reverted, and hopefully this can help you better navigate where things will go in 2021 as a real estate investor in Toronto. Before I go on, please remember to subscribe to our channel and hit the notification bell so you don't miss other real estate investing videos from our Elevate team. Real estate across the board first got impacted when we entered the initial lockdown in mid-March. Nobody left their homes, so there was practically no real estate activity from mid-March to mid-May. No matter which market you looked at, you'll see a slight dip in prices in around April and May, mainly caused by essential or panic selling. A small handful of properties were being sold at a discount because of the lack of buyers out there. Because there really wasn't much activity, you don't see the true impacts of COVID until lockdown measures started to ease in May. When people were active again, their new preferences began to surface, and that's when we began to see significant changes in supply and demand, which is the ultimate driver of prices. In general, market prices change when supply and demand move differently. So if demand drops, but supply also drops at the same pace, the market doesn't get affected too much. But when supply and demand don't move at the same pace, that's when prices really start to change. One indicator I love is the sales to new listings ratio, which tracks the relative movement of supply and demand. Markets are balanced when the sales to listings ratio is 50%, a seller's market when it's above 50%, and a buyer's market when it's under 50%. It's important to use it correctly, which means you should compare the ratio with the same period in previous years instead of looking at differences from month to month, which might be due to regular seasonalities. The first big change to real estate due to COVID-19 happened in condos. No matter if you're looking at condos in the Toronto core or looking at the suburbs in the GTA, COVID impacted condos on the downside. What was happening was that people wanted more space because they were working from home, so condo homeowners started to sell their condos. A similar thing happened on the rental side, and renters also wanted to move out of condos. Some into bigger spaces, and others moved back home since there wasn't a need to live separately close to work downtown. This created a jump in rental vacancies and at the same time a drop in condo rents. So many condo investors also sold to cash out. The summary here is that even though condo demand didn't change significantly, supply surged, and this is what caused the big change in the condo market. This is really obvious when you look at the sales to listings ratio. As you can see, the sales to listings ratio for GTA condos was consistently lower by around 24% ever since April. Ultimately, this change meant slower growth in GTA condo prices. Year-on-year growth in Q1 2020 was a very high double-digit 16%, but they ended the year off with a decent but lower 6% year-on-year growth in December. This was way more drastic in Toronto condos because the sales to listings ratio was consistently 30% lower since April, going from a strong seller's market to now a buyer's market. This translates to Toronto condos going from a high double-digit year-on-year growth of 17% in Q1 and ending the year off with a 5% decline year-on-year. Besides condos, the other big change happened in freehold outside of the Toronto core. Now, I talked about condo homeowners selling, and many of them ended up buying houses in the GTA suburbs. I dive into this in another video, so if you want to learn more about what happened, make sure you check out this video right here. For the GTA freeholds, you can see that the 2020 sales to listings ratio stayed on average 15% higher than the same month in 2019, signaling a much hotter seller's market since COVID. Demand went up and supply was stable, so GTA freeholds was the best performer in 2020. In Q1 2020, the average year-on-year gain was 11%, but we ended the year off with a 23% year-on-year gain. Finally, let's see how our favorite market, core Toronto freeholds, did in 2020. The reason we love Toronto Freeholds so much is because we believe it has the best and most stable long-term appreciation and cash flows, and the final numbers in 2020 have really validated our beliefs. Despite COVID, supply and demand continue to move in line with each other in 2020. The main reason is that most end users stayed put. Those who decided to sell because of COVID were countered by a similar amount of demand. So even though rents did drop in spring, vacancies didn't change in the freehold market. And when you combine this with all-time low interest rates, you still get very attractive positive cash flows for new freehold purchases. In a way, you can say it's a bit boring when you look at the sales to listings ratio for detached properties in core Toronto. The 2019 and 2020 ratios are almost overlapping once we pass the first lockdown, and this means that the sales conditions haven't really changed much due to COVID. On the sales side, the Q1 Toronto freehold prices saw a year-on-year growth of 16% versus 8% at the end of the year, which is still very good. Now, going back to what I talked about at the beginning of this video, there's been discussions about a market reversal in 2021, mainly for the stock markets. Some analysts predict that assets that outperformed during the COVID pandemic will see a reversal or slowdown, and assets that underperformed will start to recover, translating to a higher chance of appreciation. If you apply this to real estate, this could mean that freeholds in the suburbs might see a period of slower appreciation, and condos might see a higher uptick in appreciation once offices, immigrations, and schools bounce back. Keep in mind that it's also possible that the condo demand might not be as high as before because people are choosing more to work from home permanently. So if you believe the COVID reversal story, you can try to bet on higher appreciation, but keep in mind that this is higher risk, and at the end of the day, it's speculation. On our Elevate team, we believe that core Toronto freeholds offer the most stable and best long-term returns. Our view is based on fundamentals. They're not making any more land in Toronto. Demand for housing in core Toronto will always be strong in the long run, and there will be better cash flows in Toronto freeholds compared to Toronto condos. When it comes to investing in Toronto freeholds, we know the market inside out. We have the data insights and financial projections to help you make more informed decisions, and we have end-to-end investing services to help you out, from sales to leasing to property management and value-add upgrades, to help you build and grow. And of course, we personally invest in it too. So if you need help with investing in freeholds in core Toronto, we're happy to chat all about it. You can connect with us by heading to the link I'll put in the description below. Finally, if you enjoyed this video, please remember to give us a thumbs up and help us out by sharing it on your social media and tag us at Elevate Realty CA. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video.